Hello and welcome to today's video. My name is Eric, and today we're just going to be addressing specifically debit spread opportunities on either a daily basis or an intraday basis and build a profile of who a debit spread might be for. Now we're looking at IWM, which is the ETF for the iShares Russell 2000, and we're focusing on a daily chart here for 5/11. So that's today's date, and we're going to talk about a trade that could have been taken over the weekend and how it's set up. So in this case, we can see on Wednesday where price moved higher. On Thursday, price moved even higher, but then gapped down lower or moved down lower intraday. And then on Friday, we had a close just above 284, and we saw a setup to get bullish based on this candle that completely engulfed the previous one, and the market as a trend moving higher anyway. So in this case, the opportunity for a trade to be put on a daily basis came on Friday when we saw price close just barely bullish at about the 284 level. And so we put a trade on, a bullish trade. In other words, we're anticipating price to go higher, in which we bought the 284 call and sold the 286 call and created a spread, which we paid about 99 cents for or less. And over the weekend, when Friday closed, Monday gapped open, moved higher, we were able to sell that spread for about a 20 to 30% return, depending on where you got out. Now, this is on a daily basis, and so this is for the type of trader that does not want to be involved with all the ups and downs in the course of the day or the volatility of that. Now, again, we use debit spreads to mitigate volatility, but still have a bias in which direction something is going, but not have to worry about the short duration of the option, giving us volatility where we might not stay in the trade. So let's look at an intraday opportunity for the individual who is more inclined to maybe put a spread on and hold it for just the day. Now, again, we're using the IWM. This one happens to be an hourly chart, so we're on a 1 hour time frame. And if we look at the 5/4 period of time on May 4th, we can see where price opened up here at the market open at about 277, almost 278, moved higher to about 280 in the first hour. The next hour retraced to 279.40 or so, and then moved even higher to about 280.60, and then closed down here at about 280, just above 280, and then sharply moved lower back down to the 277 area, and then settled here at about 277.80. Now, you could have traded a call or a bullish debit spread in the opening hour or two, and then a bearish debit spread into the later part of the afternoon or the close. So this type of trade would be suitable for somebody who wants to trade intraday, maybe on an hourly chart or a 15-minute chart, and can see price activity pinned between about 280 and 277, and wants to take advantage of that intraday by, in the case of a call, maybe bought a 278 call here, short duration, maybe expiring on Friday, and sold a 280 call, and then watched as price moved higher to take advantage of the appreciation of those options. Or they could have bought a put debit spread, in which we anticipate price moving lower. They would have bought the 280 and sold the 278. So they'd be working with these two strikes, 280 and 278, and seeing a significant decline into the about noon to 2 o'clock hour Eastern time, and are able to make a 20 to 30% return in that period of time using a debit spread and mitigating volatility in the course of the day, but still being able to take advantage of a bias of price moving up or price moving down. So those are the two scenarios in which debit spreads would be suitable, and for whom they are suitable in being used both intraday and on an overnight basis. Click on the link below if you'd like more information about how we use debit spreads and the way in which you can take advantage of them.